All right, so the return on net operating assets. We've done ROA, which is easy. Net income divided by assets, super easy. But RNOA is complicated because the numerator is NOPAT, NOPAT. That's the tricky one we just did. The denominator is also tricky. It's net operating assets, which has all the red versus black, but it's even more complicated because it's average. You take the average NOA from this year compared to last year, take the average, and that's the denominator. So this number is highly, highly engineered. And we got to 22.8. So the interpretation is Intel has healthy return on operating assets. We've seen this already. But how did they accomplish this? Was it from operations, investments, or financing? So we have to disaggregate it a little bit further to see how it made its money. So if we compare a traditional measure of ROA with this much more complicated method of RNOA, we see that it's 11.7% on ROA, but 22.8% are RNOA. And that is much higher because when we look at operating in Intel, it excludes all those non-operating things, right? We have $32 billion of like cash and investments. What if we only evaluate their running of the business? They're very, very profitable. So you say, well, then why is the ROA so bad? Well, the ROA is bad. I guess you would say lower is bad because they have such a stockpiled amount of cash. They are really in a very strong position to do further acquisitions or expansions or new products. And so the shareholders and the directors must be comfortable or must accept that Intel is in a very aggressive posture to acquire or to grow. And they let them have $32 billion of cash lying around. So learning objective 9, we're going to disaggregate just like we've been disaggregating in DuPont. So we take RNOA and we do this whole trick with the sales on both sides. So NOPAT divided by sales is NOPAT margin. Sales divided by average NOA is net operating asset turnover. So NOPM and NOAT. So the first says for every dollar of sales, how much do we make in NOPAT, in profit? The other one is for every dollar of assets, how much sales do we get? And again, it's a measure of productivity. All right, let's look at Intel and how they did. So first on RNOA, we've computed this previously, so I just carried it forward, 22.86. So the question is, how did it get there? From profitability or from asset turnover? Profitability is 20.39, so most of it comes from just being very profitable and running their business. Asset turn, nothing kind of crazy, it's 1.12. For every dollar of assets or net operating assets, they have $1 of sales. So they pick up a little bit more because it's 1.12. So predominantly, they're very profitable. Their asset turnover is a little over 1. So they're just a very powerful, well-run company. So interpretations, we look at NOPM, profit margin, based on kind of the gross profit, operating expense, and look at what's going on there and how they might improve it. Net operating asset turnover, remember, is sales divided by assets, net operating assets. So you can make the numerator higher by having more sales, or you can make the denominator smaller by having fewer assets or having more operating liabilities. So there's ways to increase it. And the way to look at it is just look at the formula. If you want it to go up, look for making the numerator higher or denominator smaller. If you want the ratio to go down, make the numerator lower or make the denominator higher, right? Basic mathematics. Just use that and apply it to business. So this is a complicated graph because it compares for many industries how the profitability relates to turnover. Horizontal is profit margin, vertical is asset turnover. So this curve here represents a steady amount ROA. So we can see on this side, pharmaceuticals, medical instrument, data processing, biotech are all kind of northeast of the line, which means for a given level of profit margin, they have a higher asset turn than the industry. So they achieve it with high asset turn. We've completed Module 4, which is analysis of financial statements. So we did traditional and kind of operational component analysis In traditional, we looked at ROE, which is net income divided by average shareholders' equity, and the higher the better, right? So we want more net income, or we want to be skinnier in our equity requirements. DuPont is a disaggregation where we break ROE into ROA and leverage. And we looked at how we can use the different dials and switches to improve ROE, and also is useful for dissecting where the company makes its money. Next, we went even a little further and we took the ROA component of DuPont and we further disaggregated that into return on sales and on productivity. And so do we have high margins, or do we have high asset turnover? Next, we looked at a related measure to leverage, which is liquidity and solvency. Liquidity is our ability to meet short-term needs. Solvency is our ability to manage and ultimately pay off our debt without having financial distress, defaults, or bankruptcy. And analytical tools, we looked at common sizing, and we looked at both vertical and horizontal analysis. Vertical is looking at a balance sheet and stating things as a percent of assets. Vertical for income statement is stating everything as a percent of sales. Horizontal, going this way, is looking at ratios or numbers over time. And these analyses are useful for a company and also looking at an industry. When we look at the operating component, digging a little deeper, we first had to do some background calculations to determine the net operating assets by, again, stripping out non-operating assets and non-operating liabilities. We looked at the income statement and we derived net operating profit after tax, NOPAT, which is stripping out all the operating items, the revenues and operating expenses, and then adjusting the interest or the income tax rate to reflect how much taxes we pay, or we estimated we paid, on the operating parts only and not on the interest shield. And we looked at RNOA, which is kind of the combination of the balance sheet and income statement analysis we just did. And again, we could disaggregate. We can disaggregate RNOA into the components of profitability and asset turn. So a lot of number crunching. And again, this is the core of your financial analysis project, and also the core of what you would do if somebody threw on your table, on your desk, the financial statement, said, what do you think? You kind of subject you to this battery of tests. So if you're going to the doctor, it would be like doing the blood panel, right? So we're kind of throwing a series of tests at the company, and from that, we'll be able to learn a lot about how the company's doing, even if you've never seen the company before. All right, so a reminder, make sure you pick your company by next week, and also competitors, so you could do a benchmark, and email me your companies, and I'll sort out who gets what. Try to give everyone at least one of their top choices. And in my experience, we have a lot of popular companies, and so I often have to go below choice number one. So be safe and give me somewhere between 3 and 5 companies, and we'll try to accommodate everyone's wishes. Thank you. Bye-bye. See you in class.